Okay, time to keep going through our variety of intercompany transactions that we may need to deal with in consolidation. So let's dive back in. So we've dealt with intercompany inventory transactions or merchandise sales. The next one we're going to talk about is intercompany bond transactions. And this is, let's say company A has outstanding bonds. So they've issued bonds at some point in the past. It's out there in the open market. And then this second company that's now acquiring them says, yeah, we don't really like having that debt outstanding, so we're going to buy it all up. So they buy all those bonds. Well, in this case, what's the substance of what happened? What does GAAP see? Well, GAAP says, well, effectively, you've just bought back all the debt and retired it, and that could trigger the recognition of a gain or a loss. Ultimately, if the price paid to acquire the debt was different than the book value of that debt, that's what would result in a gain or a loss. Now, what's interesting, is it a gain or a loss to the parent? No. Is it a gain or loss to the subsidiary? No. Why? Well, it wouldn't make sense for it to be the subsidiary. They didn't really do anything if they're the ones that originally issued the bonds. And technically, it's not the parent either. All the parent did was invest their money in an investment, a bond. It's only in consolidation, another example of, well, really what happened was the old left hand was trading off with the right hand, and so that gain or loss only shows up on consolidation. And any other intercompany balances, for example, if there was accrued interest payable and accrued interest receivable, anything like that, those would be eliminated as well. So let's take a look at an example. At the end of year one, Garrity Corporation issues bonds. They have a carrying value of $300,000, but they have a face value of only $250,000. In other words, they were issued at a $50,000 premium. Now, Garrity recorded this when they made that entry. Well, they said, we got paid, we got $300,000, that's what we sold that stock for, so debit cash, $300,000. They record the bond payable for the face value of those bonds, that's $250,000. And they're going to record a credit for a premium on bonds payable, making the net book value or the carrying value of the bonds $300,000 in total. But then, that very same day, I guess we're going to go with that morning they issued the bonds, and later that afternoon, busy New Year's Eve, before any portion of the premium was amortized, here comes Olinto Corporation, and they buy up all the outstanding bonds, and they're able to do it at $275,000. Now, by the way, if you ever could do this, I would do it every day of the week. I mean, think about that. Somehow I'm able to sell a bunch of bonds and get $300,000 and then buy them all back for less minutes later. Is it realistic? Probably not. But for the purpose of illustrating, it'll work. So what does Olinto record? Well, they recorded an investment. They bought an investment in bonds. So that's a debit for $275 and a credit for cash because that's their basis in those bonds. But at this moment, if Garrity and Olinto are parent subsidiary in that kind of a relationship, that has now effectively retired those bonds, and that's what we record in elimination. What's the built-in gain? Well, it's $25,000, right? When Garrity issued them, they got $300K. When Olinto bought them, they only had to use $275 to cancel them out. So there was a net benefit of $25,000. So here comes the eliminating entry. Garrity says, well, this is great. The bonds are gone then from our perspective. So we're going to debit the net book value. Debiting the carrying value means wipe out the bond payable, wipe out the premium. Olinto says, well, that eliminates my investment in those bonds in the same manner. So they had that investment on their books for $275. We're going to eliminate that. And the plug here is the gain on the extinguishment. Again, is it on the parents or the subs books? The answer is it's on neither. It only shows up in consolidation. What about intercompany interest? Eliminated. Whether we're talking about the interest expense for the issuer of the bonds, whether we're talking about the interest income for the investor in the bonds, whether we're talking about payables and receivables, all of that needs to be eliminated. In addition, what about amortizing that discount or that premium? Same thing. Remember, ultimately, that discount or premium amortization rolls into interest for all intents and purposes. And if I'm going to make the argument that interest is always eliminated, well, then the amortization is also eliminated. Not to mention, the unamortized portion of the bond payable, whatever that premium or discount is, would be eliminated as well. How does this continue off into the future? Well, ultimately, as we're going to go through, there's going to be this unrecorded gain or this unrecorded loss. Well, it was recorded when the original elimination happened. So from that point on, it's going to be in retained earnings, because the notion would be, well, we would have recorded that gain or loss year or years ago. It's already booked. So now it would be carried in retained earnings. If the bonds were from a subsidiary and there's a non-controlling interest involved, well, then the non-controlling interest would still bear some of the impact of that. So yes, it is possible that the non-controlling interest would also need to be adjusted as a result. All right. So we've sold merchandise. We've retired bonds. What else could we do? Well, a big one is we could buy or sell fixed assets. We're going to deal with the easiest of the bunch, land. Why is it easier? Because you don't depreciate it. It makes it a little more straightforward. If the land is sold to parent to sub to parent, related parties effectively, whatever gain or whatever loss is recognized is eliminated, right? Because that is as if that transaction never happened. So the work paper elimination is going to get rid of any intercompany gain or loss, and in so doing, it's going to return the land to its original cost, which is where it was on the original company's books. So let's look at an example of that. So this time we have Garrity selling some land to Olinto for $200,000. Now when Garrity originally bought that land, it only cost $175,000, and that's what it's on Garrity's books for. So from Garrity's perspective, this is just the sale of an asset. Debit cash for the full amount paid, credit to remove the land from their books. The net effect is a gain. It's an intercompany gain on the sale of land for $25,000. As far as Olinto's concerned, they could care less what that gain or loss was, just like they really didn't care about what Garrity paid for inventory. All they know is we spent $200,000. That's the credit to cash. We bought a piece of land. It's worth $200,000. The problem is that intercompany gain cannot stand. And frankly, this is a great example of, well, what else could you possibly affect with the journal entry? Well, the one thing I'm sure you don't touch is cash. It's right. If one company spends money and one company collects money, that's right. So all we have is get rid of the intercompany gain on sale. What's the only other account that's at play here? Land. So that's how we're going to deal with it. We're going to debit to remove the gain on sale. That means we need a credit, and the credit is used to reduce the land back to its original cost basis as if the transaction never occurred. So it's going to be a credit to land for that same $25,000. Now, what happens after that? Well, every year thereafter, the gain or loss has already happened. So it's going to continue to be there, but now it's rolling into retained earnings. So that would be affected in subsequent years because that's where it would have been closed to. Now, is there any reason to divide the gain on the sale of the land with a non-controlling interest? In this case, no. Why? Because the non-controlling interest, whomever that is, one company or many, they weren't buying or selling the land. They're not part of that transaction at all. So there would be no logical reason for us to allocate any portion of the impact to the non-controlling interest, which again, makes things a little simpler. All right, we've dealt with that, but I bet you can guess what's still on our list to tackle. Yeah, if we've dealt with the intercompany sale of a fixed asset, but specifically land, that leaves what about other kinds of fixed assets? So we'll see that in the next video. Thanks.